Ladies and gentlemen, good day and welcome to Polycab India Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gandharv Tongia, Chief Financial Officer, Polycab India Limited. Thank you, and over to you, sir.
Thank you, operator, and very good noon, everyone. I hope you all are doing well. It's a pleasure to have you on the call. As operator mentioned, my name is Gandharv Tongia, and I am the CFO at Polycab India Limited. Thanks for joining us today to discuss our Q1 FY23 earnings. During the call, we will be referring to the presentation, financial results, and financial statements which are available on the stock exchanges as well as investor relations webpage of our website. It can also be downloaded through QR code on slide number 8 of earnings presentation. From our management team, we have with us our Chairman and Managing Director, Mr. Inder T. Jaisinghani. Let me now hand it over to him for his opening comments.
Good afternoon, everyone. We have started the fiscal year 2023 on solid footing, with top line growth of 48% fueled by strong performance across B2B and B2C, which underline our strategy to be agile, focused on robust execution and consistency, delivering the best quality of the product to our customer. Profitability was supported by the better operating leverage and various strategic initiatives implemented over the past few quarters. We will strive to continue the path of profitable and sustainable growth and contribute to the success of all our stakeholders. I now request Gandharv to take you through our earnings presentation.
Thank you, Inder bhai. Revenue growth of 48% marks the beginning of FY23 on a promising note, as most of our businesses are now performing above pre-pandemic levels. The numbers might look upbeat due to low base, but we are seeing sustainable improvement in our underlying businesses. More importantly, we are progressing well on our strategic agenda, which will drive transformation over mid to long term. The current quarter breaks the rhythm of back-to-back impacted Q1 results, turning it to be the best Q1 in the history of the company in terms of revenue and margins. Before I take you through the presentation, let me give you a flavor of macro environment. Overall macro environment has been a bit of mixed bag during the quarter. Global economy is going through an extremely uncertain period amidst the simultaneous interplay of various headwinds, lingering war and enduring COVID, the sharp volatility in energy and other commodity prices, strains in global supply chains, and worsening food security. In several economies, inflation is ruling at levels not seen by the recent generation. For advanced countries, against an inflation target of 2% and emerging markets against an average target of about 3 to 5%, two-thirds are witnessing inflation above 7%. The sharply tightening financial condition due to the ongoing monetary normalization on the one hand and the persisting geopolitical tensions on the other pose significant downside risk to near-term global economic prospects. The global economy is projected to decelerate significantly during 2022 by all multilateral agencies. The outlook is shrouded in high uncertainty. A silver of hope has been visible in the recent moderation in global commodity prices and especially food prices. Back home, the Indian economy has, however, shown some dynamism. Several indicators suggest that the Indian economy is making resilient progress in Q1 FY23 in spite of the drag from global spillovers, elevated inflation, and some slackening of external demand as geopolitical developments take their toll on world trade. The high-frequency indicators for first quarter are mixed. However, amidst a sea of red and yellow, greens are making their appearance. For example, GST collections for the first quarter stood at over rupees 4.5 lakh crore, up 37% year-on-year, while other indicators such as services, PMI, IIP, core sector all showed meaningful improvement. India's foreign exchange reserves are approximately close to nearly 10 months of imports projected for the current fiscal, thereby providing a sufficient buffer against external shocks. However, on the contrary, consumer sentiment still remains below pre-pandemic levels, which was emphasized by RBI's Consumer Confidence Survey. It is expected that the consumer demand in the urban market remains resilient, while a pickup in monsoon will support the rural market, which have been showing a consumption stress. Besides, most of the commodity costs have been corrected in the last couple of months, offering some respite to the adverse macros. Thus, the glass seems half full, perfectly balancing ambiguity with some silver lining. Meanwhile, on our business, we remain agile through our portfolio and go-to-market strategies, which gives us confidence to drive industry-leading growth. Moving on to the presentation, slide number 4. For the quarter ended 30th June 2022, our consolidated revenue grew by 48% year-on-year. EBITDA more than doubled in the first quarter, while EBITDA margins improved by almost 420 basis points year-on-year to 11.3%, led by better operating leverages and calibrated price hikes. During the quarter, we launched several brand campaigns across TV, digital, and social media platforms. Seminars and influencers meet helped us to improve awareness amongst B2B customers, electricians, and contractors, amongst others. Moving on, other expenses were broadly in line. Overall finance costs stood at rupees 84 million and other income at rupees 443 million. A detailed breakup of our other income and finance costs have been provided on slide 12 of our earnings presentation. PAT also tripled on year-on-year basis to rupees 2.23 billion. On segmental results, the current quarter is yet another example of how the diversity of our growth levers come into play. Moving on to slide number 5, wires and cables, which is our largest business, saw a strong top-line growth of 48% year-on-year, led by healthy channel sales, while institutional business also witnessed growth traction. On the geographical front, the growth was broad-based, with the highest contribution from West, followed by South, North, and East regions. During the quarter, wire business was slightly impacted by high volatility in metal prices. Consequently, the inventory levels in trade were slightly below normal, and overall cash cycle also slowed. Despite these challenges, it is pleasing to note that the blended wire and cable volume grew on a year-on-year basis and is also higher than pre-pandemic levels. Export business contributed 6.7% to consolidated revenue and reported a healthy revenue growth of 62%. We have put in considerate effort over the last few years in terms of new product development, getting approvals, and penetrating new geographies. This is now materializing as we are seeing many repeat orders from large customers globally. Our focus on achieving double-digit contribution target over the medium term for this business remains intact. On slide number 6, our FMEG business grew by 59% year-on-year to rupees 305 crores. April month saw robust momentum. However, June was impacted by weaker trade and consumer sentiment arising out of inflation. The growth is quite structural, supported by strategic intervention and distribution expansion. Segmental operating profit increased to rupees 62 million with a 2% margin, largely on account of pricing action, cost-saving initiatives, and premiumization, which have been partly offset by input cost pressure. While lighting, switchgear, and pumps continued their strong growth momentum, fans, conduit pipes, and solar businesses posted healthy growth. However, switches saw a decline due to supply challenges. On slide 7, other segments, which are largely comprised of our EPC business, witnessed a 31% year-on-year increase in revenue to rupees 75 crore rupees. Our debt to equity ratio is strong at 0.02x, and we are at net cash of around 590 crores. On the working capital side, there are a couple of things to highlight. One, receivable days are at comfortable level. We will continue to optimize this progressively with the help of non-recourse channel financing. Second, inventory levels are higher than normal because we were anticipating better demand in the month of June. However, as I highlighted a while back, the trade sentiment was negative or went down a bit due to high volatility in metal prices, and dealers and retailers reduced their stock levels in the month of June. On payables, due to change in the procurement pattern from international to local vendors, the payment terms underwent a change from advance to LCs, and that has resulted into reduction of liability. We expect this to normalize in 1 or 2 quarters. Now let's talk about our key project, Project Leap. In the first quarter of the fiscal 2022-23, we primarily worked on 4 key areas. 1, customer centricity. 2nd, go-to-market excellence. 3rd, winning with new products. And last is setup of organization and digital enablers. Starting with customer centricity, under this initiative, we have successfully integrated GTM for go-to-market for cable and wire B2B segment. This will materially improve our customer servicing capability as well as create one single route for our B2B customers. We have improved our understanding of the customer and its preference by using various tools and appointment of dedicated KAM or key account managers, which helps us to better serve our customers. We are also implementing pilot projects focusing on deepening reach and engagement with IHB and allied influencers. Second area is go-to-market excellence. We are putting lots of efforts on enhancing our presence. During the quarter, our B2B cable and wire reach expanded to additional 27 new districts. For FMEG, we have added around 100 new distributors, while also strengthened our presence in modern trade and e-commerce channels. Next, we are building a winning portfolio of our products which are innovative and resolve consumer needs. During the first quarter, we have already launched 15 and 62 new products, mainly focused on premium and underserved segments in fans and lights, respectively. Our premiumization journey is progressing well, with premium products now contribute almost 12% to our consumer business, which was just 8% in fiscal 22 and 4% in fiscal 21. Fourth area is setup of organization and digital enablers. Within this, the major initiative was setting up the right organization structure and fill critical capability gaps across the departments and businesses. Majority of talent acquisition for critical roles was completed across business and functions, while performance measures and reward recognition were aligned to the growth strategy. We also successfully instituted end-to-end digitalization of front-end sales across businesses. So that was broadly on Q1 FY23. Going ahead, we have pinned down some key focus areas for the next few months. One is enabling customer centricity in B2B business, through which we are driving our sales team towards better consumer and customer understanding and expanding our customer view to include all relevant information in customer life cycle. Secondly, expanding our reach and distribution across businesses, which includes expanding coverage to 200 plus districts for B2B. And a scale up of emerging India to identify in the identified priority state. Third, winning in the new products in B2C businesses. We have a strong NPD pipeline to strengthen and build differentiated portfolio in FMEG businesses. Fourth, driving a digital agenda and creating a digital first organization under which we are strengthening our digital infrastructure across Salesforce, distributors, retailers, and influencers. Lastly, emphasis on governance, where we have bottom-up and granular target setting approach deployed with linkages to scorecards across levels of business and functional teams. So that's about it on Leap. We will continue to share periodic updates and are excited to see how the rest of the year pans out. Thank you. And with that, I hand it over to operators for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Atul Tiwari from Citigroup. Please go ahead.
Hi sir. Thanks a lot for the opportunity and congrats on good set of numbers. Just a couple of questions on cables and wire business. So we have seen a very sharp commodity price crash over past 45 days or so. So have you passed all of that in your end product pricing, and how it should impact your margins over next 2 to 3 quarters? So that is one question. First question. And the second one is now that there is a widespread expectation that prices of the cables and wire product will be reduced. Are you seeing reduced demand from channel, and how long that is likely to continue?
Thanks, Atul. Thanks a lot for your kind words. I think your first question was around margins and whether we have passed on all the benefits to the end consumer or customer. So you know this business, Atul. Historically, we have maintained EBITDA margins of 11 to 13% in cable and wire, and we believe in the quarters and years to come, we should be able to maintain the same range. In the current quarter also, it was 11%. Almost 87% of our business comes from dealers and distributors, and where we revise our prices at least on monthly rest. And when we revise these prices, we consider two factors predominantly. One is changes in copper and aluminum LME, and second is change in USD INR exchange rate. And this is what we have done even in the current quarters, and we will continue to do that in the subsequent quarters as well. So to answer the question, we expect to maintain a margin of 11 to 13%. Second, on demand, generally in the falling commodity prices, we have observed that dealers and distributors, they generally optimize the inventory at their end, and this is what we witnessed in the month of June. Expectation broadly is that we should have some stability in commodity prices in a month or so, and after that, I would not expect a significant correction in the inventory levels of our dealers and distributors. It is expected that the second half of the year would be better than the first half of the current fiscal.
Okay, sir. Thanks a lot.
Thank you, Atul.
Thank you. The next question is from the line of Naval from MK Global. Please go ahead.
Yeah, thank you for the opportunity. I have 2-3 questions, Gandhar. First, as you stated, volumes have seen growth over pre-pandemic levels also. Can you give out any number on that? That is first question. Second, on Project Leap, because when we gave our Project Leap guidance of 20,000 crores revenue by 26, copper prices were kind of 20-22% higher than the current levels. So if copper prices or the other commodities are going to stay where they are right now, so will there be any change in timeline or number on this 20,000 crores? And third question is on the unorganized players, where last year we have seen unorganized players facing difficulties because of spike in commodity prices. So do you think that they will come back in this year as things are now falling in place with commodity cooling off?
Great. Thanks, Naval. So I'll go in the same order. I think your first question was around the volume growth, and you rightly observed that we have registered a fair amount of volume plus value growth. If I were to give you a broad color on the current quarter growth of 48%, it is safe to assume that most of it, almost 2/3, is coming from volume, and balance is because of the pricing action which we have taken. I think your second question was around the top line target of 20,000 crore by fiscal 2026. So when we were working on this top line target as part of initial thoughts in the Project Leap around a year back, we considered last 5 years movement in copper and aluminum LME as well as in USD INR exchange rate, and of course we factored in some management estimates. At this stage, considering as a mid to long term view, I don't think we need to revise the top line of 20,000 crore rupees, but we will continue to keep you updated. At this stage, I as well as the larger management team is confident of touching 20,000 crore of top line by fiscal 2026. Third is on the unorganized. My sense is, like other industries, this industry will continue to move towards more organized market players, irrespective of what happens to the commodity prices. And I would be surprised if unorganized market share increases in the quarters to come or years to come.
Sure. Just a follow-up on the first question of volumes. Can you state number on pre-pandemic level on volume growth? As you stated in your opening remarks that there was volume growth on pre-pandemic levels as well.
Yeah. This is true that we have been able to register a fair amount of growth, but it would be slightly incorrect on my part to give you that number, because in our business, a kilometer length of copper cable would be different in terms of value and volume when I compare with the aluminum. So I think it's safe to assume that we are ahead of the curve as far as the industry growth is concerned. But if I were to give you only specific response to this particular quarter with June 21, I think most of it is coming because of volume and a part is because of value.
Sure. And if may, one last question on the again commodity prices. Have we started? You stated that H2 will be better than H1, but do you think that last year volumes were impacted because of a significant increase in commodity prices? And have you started to see some green shoots where demand coming back, or some demand which might have got postponed last year will come back this year?
Theoretically, yes, that's possible. But as of now, when we speak, I have not seen any significant or dramatic change in demand. As a matter of fact, June was slightly softer. And it appears that there will be some impact of the softer commodity prices even the second quarter. But broadly, from third quarter onwards, we should see some uptick in demand. And second half of the year should be significantly better than the first half of the year.
Sure. Thank you so much and all the best.
Thank you so much, Navud.
Thank you. The next question is from the line of Achal Lohade from JM Financial.
Yeah, hi, good afternoon. Thank you for the opportunity. My question was, if you could help us understand the FMEG part. First, in terms of the revenue mix, if you could break it into key products. And you did point out to, a drop in switches. If you could, give some sense as to what exactly is the issue out there, and how do you see it going forward?
Sure. So we have broadly 5 or 6 sub-product categories within FMEG. One is fan, second is light and loop, switches and switchgear, conduit pipe, bit of solar, a bit of agro pumps. Fan contributes almost 30-35% to our top line of FMEG, and light and loom is also a number closer to the same range. And other businesses are slightly smaller. Fan got impacted in this quarter. As you remember, in the previous quarter, we had mentioned that we are doing the alignment exercise in fan business because we believe to achieve a significantly larger top line within fan business, we need to revisit our GTM, dealer distributors and all that. So there is some impact on fan business. But on a consistent basis, we would expect fan and light and loom both put together should contribute almost 65-70% to our FMEG business, followed by other smaller business. As far as switches are concerned, any which way is a smaller business for us. But this is the only product where we were dependent on third-party supplies, and we had some supply side issues on that. But parallelly, we have started, our process of setting up our own factory for switches. It is expected to be up and running in the current fiscal as well. And once that factory is operational, we should not face any significant issues on supply side of switches.
But you think you will have all the approvals with respect to, because I recall for another company, it took a lot of time to get the approval, the government approvals required to launch the switches and switchgears.
So I think we have a very good handle on the approvals on switches as well as on the other businesses approvals. I don't expect any significant challenges in launching our own switches in the current fiscal itself.
Got it. If you could help us, what is the capex you are incurring, and what's the capacity and the revenue potential of this?
Sure. So historically, we have incurred between 300 to 350 crore rupees every year. This year as well, we are anticipating a number close to 300 to 400 crore rupees. When we were working on Project Leap, there were several priorities. So what we decided that in the year 2 of Project Leap, we will start exploring adjacent categories and see whether we have to enter into these categories either through M&A route or otherwise through our own facilities. So if we decide to get into adjacent product categories, that number of 300-400 crore rupees will probably undergo a change. But that's a work which is in progress. I think during the course of the year, I should be able to give you additional color on this. And against the 300 to 400 crore rupees target of the current year capex, we have incurred almost 100 crore rupees in the first quarter.
And specifically on this facility, what is for the switches facility, what is the capex and the volume and the revenue potential for the asset turn?
So FMEG business is generally a lighter business in terms of capital intensity. We should be able to get anywhere between 6 to 8x of the capex spend. Once the facility is up and running, we will come back to you with additional color and data on the switches business.
Got it. Just one more question I had, if I may ask. With respect to the distribution, you had talked about the overlap, and you have pointed out in the slide it's about 25% is a common distribution. What I wanted to check, this classification is based on the retail mix or the dealer/distributor mix. How have you worked out this mix?
Yeah, the data which you talked about is the dealers and distributors, and the classification is on the basis of type of product they procure from our company. So if they are procuring cable and wire, then they are cable and wire dealer and distributor. If they are procuring FMEG products, then they are FMEG distributor. But almost in 25% of cases, dealers and distributors are procuring both the products, and that is the number which you were referring.
Sorry, that number is 45 or 25? Because I saw it is the 25.
25% are the dealers who are procuring both the products, cable and wire.
So in effect, you are saying there is 75% of our dealer distributors of wires, they are not actually buying FMEG. Is that understanding right?
Or other way around. There are 75% dealers and distributors who are either doing only cable and wire or only doing FMEG.
Understood. And just one clarification on the slide. If I see the map of the manufacturing locations, I see 3 places. You have written 23 units of manufacturing, so just wanted to get that clarity.
Yes. So there are multiple manufacturing locations in these geographical locations. If you go to Halol, there are manufacturing facilities for different type of cables and wires, and these numbers of locations are as per the regulatory approvals which you have.
Got it. This is very helpful. I'll come back in the queue for follow-up questions. Thank you so much.
You are welcome.
Thank you. The next question is from the line of Uttan Kumar from Spark Capital. Please go ahead.
Good noon, sir. Thank you for the opportunity. I think all the questions have already been answered. I would like to ask a question on the demand trend. So currently, how do you see the current demand panning out over the next 1 to 2 years, considering that now we are witnessing a scenario where the interest rates are on the higher side? And are we really seeing the interest rate gaining traction, or is there really certain pockets which are kind of driving the volume growth for us?
Yeah. Your voice was cracking in between. I think you are talking about the demand outlook. Is that the correct?
Yes, sir. Yes.
Yeah.
Yes, sir.
So, as I briefly mentioned in my opening remarks, the June month got impacted because of significant softening of commodity prices. The expectation is that the commodity prices will get stabilized in a month or so, and after that we should not have any significant challenge as far as demand is concerned. Ours is a business which is a distribution play. Almost 87% of our top line comes from dealers and distributors. And whenever there is a significant softening of prices, generally dealers and distributors, they optimize their inventory level. But as you could imagine, this is only a near-term or immediate-term impact. It doesn't impact us on a mid-term or long-term. As far as demand environment is concerned, macros are positive. You know the country already. Ours is a consumption story as well as manufacturing story. When I think of China, I can think of only manufacturing. When I think of US, I can think of only consumption. Whereas in the case of our country, it has benefits of both. We can produce as well as we can consume, and that is where I don't see any challenge in terms of demand over mid to long term.
Right, sir. So secondly, with regards to the raw materials, the company has divested acre base recently to Concall. So just want to understand in terms of the copper procurement. Right. So in this case, is there any kind of, could you just give us more clarity on what kind of terms we have in terms of procurement of copper from them? is there any kind of advantage that the company enjoys in terms of maybe receiving the raw materials at the lower price or at a discount, or is there any other third party also would be supplying copper to you, or is it only from Hindelco to whom will be currently sourcing the entire raw?
Sure. So the transaction which you are referring to was consummated in December of last year. Riker was a subsidiary which was supplying or converting one form of copper into another form. We used to procure, and even now also procure, copper in cathode form from overseas supplier as well as few local suppliers. And Riker used to convert those cathodes into rods, and that is where the rods were being used by our manufacturing facilities to manufacture cables and wires. So this transaction doesn't impact the procurement philosophy or procurement strength which company enjoys. It was only a converter, and as you would probably be able to recollect, when we did this transaction, simultaneously we entered into a multi-year job conversion or subcontracting arrangement with Riker, which is now part of Hindelco. So we continue to get the same benefit which we were enjoying earlier. Why we decided to divest Riker? Because Riker was not being utilized at 100% capacity. Our utilization was barely 30-40%, and it was not making sense from ROCE perspective to continue with that particular legal entity within our group. And this arrangement helps us both in top line as well as the bottom line. Now your question on the strength which we have or the benefits which we have on copper procurement. Before I specifically deal with that, let me demystify the copper procurement for you. Most of the commodities worldwide generally are traded with embedded derivative, which means that on the date of procurement, you need not to decide the final price which you need to pay to your vendor. You can decide it a month or 2 months or 3 months down the line. And generally, in that time frame, you are able to convert the raw material into finished goods, and you have visibility on the selling price. And that is where you decide and firm up the procurement price. And this is how the changes in raw material prices becomes a pass-through for us. And that is where it doesn't impact the profitability of our company. There could be some few instances of changes on month-on-month or quarter-on-quarter basis, but if you were to take an analyzed view, it won't have significant impact on the profitability of the company. And you know, we are the largest consumer of copper in India, and we have those benefits available both from international suppliers as well as from the domestic suppliers.
Got it, sir. So lastly, on the gross, so is it a fair understanding that the current gross margins of almost % level, it would be sustainable, or there can be some kind of improvement going ahead from here, maybe 100-200 bips? Because of either, it can be either because of the export mix which is coming in, or the current inventory being of the lower priced raw material. Is there any scope which can be there in terms of improvement, or can the current levels sustain?
So over the past few years, we have maintained EBITDA margins of 11 to 13% in our cable and wire business on an annualized basis. I think for your modeling purposes, it's best to assume a range of between 11 to 13%. And I think probably even if we are able to better the margins in terms of actual numbers, it will only give you only positive surprise and no negative shock.
Got it, sir. Got it. Thank you, sir.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The next question is from the line of Nikunj Gala from Sundaram AMC. Please go ahead.
Yeah, good afternoon, team. Sir, I just have one question with respect to your cable and wire division. When you are, mentioning that you will be maintaining your, EBITDA margin in the range of 11 to 13, but just want to understand during the deflationary, scenario, is that understanding correct that during this period your absolute, gross profit, I'm just focusing on the contribution margin perspective, that absolute gross profit in the deflationary scenario would be lower in that case?
Let me give you let me share with you my experience of this industry in the last 15 years or so. What I have observed in this industry is whenever there is reduction in commodity prices, generally the contribution margin and EBITDA margin would improve for cable and wire manufacturers, and it is other way around whenever there is increase in commodity prices. So I would expect something similar to happen if there is significant reduction in copper or aluminum prices. If that doesn't happen, I would probably then expect significant competitive intensity in the industry and significant market share gain. But generally speaking, I would expect improvement in contribution and EBITDA margin if the commodity prices are falling.
Okay, understood from that point, sir. But why I'm seeking clarity on the absolute contribution? If you look at our number from FY19 to FY22, FY19 commodities were approximately, just to give you an example of copper, from FY19 to FY22 the basket of commodity has increased by 60%. So for example purpose, for your procurement was at 75, you were selling at 100, hence your contribution margin was at 25. When I look at your FY22 number, the commodity basket moved from 75 to 120 purely on account of 60% inflation. At the same time, your realization also increased from 100 to 160. And during this period, your contribution remained 25 to 25. However, at a gross profit level, your gross profit, which was 25 rupees in FY19, had become 40. So that was scenario we have seen in the FY19-22. In the next, for the example purpose, going forward, let's take a similar example when you are procuring goods today at 75, but this 75 reduces by 20%, which has come down to 60 rupees. So I just want to understand the 100 rupees which you are selling will come down to 85 or 80. If it comes down by 85, then you try to maintain your increase your margin, but your absolute profit comes down.
Yeah, I think I probably lost you when you were changing numbers from 75 to 60%, but I think I'll probably oversimplify for you as well as for others. We work on EBITDA margin targets. We don't work on per ton targets, and that is where I gave you guidance of 11 to 13%. At the same time, what I highlighted to you in my experience in this cable and wire industry, in falling commodity prices, you should be able to get better margins both at contribution level and EBITDA level, and that is where I would suggest that for your modeling purposes, you can consider EBITDA margin in the range of 11 to 13% as far as cable and wire business is concerned. But if I were to give you color on FMEG business, which is almost 10-12% of our top line now and expected to grow over the period, the current EBITDA margin or current EBIT margin is around 2%, and we would expect to be in the range of 10 to 12% of EBITDA margin by fiscal 26, and that is where there is a fair amount of upside which is possible as far as that particular business of FMEG is concerned.
Okay, got your point. Just clarifying that in that case, you are saying if the cable and wire business 100 rupees, you are making 11 to 13 rupees, and if tomorrow this 100 rupees becomes 80 rupees on account of passing on the prices to the consumer, you will make 11 to 13 on 80 rupees. That understanding is right, right, sir?
That is partially right. What I highlighted is in my experience in the last 15 years, in the falling commodity prices, the margin should improve. And that if that happens, then you should have a positive surprise on the range of 11 to 30%.
Okay, sure, sir. Thank you. Thanks for your time. Yeah.
You are welcome.
Thank you. Next question is from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. Sir, on the new brand Etira, can you share more light? Means basically where it is launched and which are the products that we have entered right now, what is the pricing difference versus Polycab brand, and where it is exactly positioning. I agree it is at low end of the market, but compared to unorganized products or the premium products like Polycab, where it is basically positioned, and is there any 3 to 5 year target that the company is working on? Yeah.
So Etira was launched as part of of our rural as well as low-cost product offering. We have initiated our work on penetration of rural market. We have a vertical called Emerging India, which is being headed by Deepak, who joined us around a year back, and he has significant experience on the rural market. Etira was launched in the fourth quarter of the fiscal 2022, and if I'm not wrong, we have registered a 100% growth on sequential basis. Of course, numbers are small, the numbers are not very significant, but the fact is the growth of 100% shows that it's very promising. As of now, it has been launched only in the wire product portfolio. As we go forward in the current fiscal, we will introduce Etira brand for other businesses as well in FMEG, for example, pen.
Okay, and is there any target that the company is working with, 3-year, 5-year kind of a target, or?
You are absolutely right. We have a very ambitious target for the rural market, and Etira would help us in achieving that over the period. And on a quarterly basis, we'll continue to provide you updates on the actuals for the quarter gone by.
Oh, okay, sure, sir. Thank you. Thanks a lot.
You are welcome.
Next question is from the line of Kunal from B&K Securities. Please go ahead.
Sure. Thank you for the opportunity. Most of my questions have been answered. Just one question, sir. If you mentioned that, strengthening of the leadership team was one of the focus area. If you can talk a little bit about how has that moved and, what has been the key additions of late and, especially on the FMEG side, it would be really useful.
Sure. So, when we were thinking about Project Leap, and this is almost 15 months back, and we were in active discussions with our partner, Boston Consulting Group, we realized that the work streams which we identified, the count was 24 work streams as part of Project Leap. If we want to successfully implement those 24 work streams, we need probably more experience and more leaders at the top management level. And this business and company, Kunal, already. We don't have any capital risk. We are sitting on cash in our balance sheet. We are only leaders. The only risk we have, if we were to critically challenge, is execution risk. What does that mean? That even if you plan for something, you are not able to implement it in the most effective manner. And the way to mitigate that is have better quality of the leaders, have more leaders to support the journey of 20,000 crore rupees of top line by fiscal 26. So we have hired leaders for various businesses and functions in last a year or so. If I were to talk about top leaders, probably we would have hired almost 18-20 leaders. But at the same time, there is significant augmentation of middle level managers as well. Let me start with the functions first. We hired Rajesh from Tata Motors as our CHRO. He was with Tata for 28 years, and all of us know Tatas are known for their HR and people skills and practices, and we believe that Rajesh would be able to support us in transforming HR practices of Polycab. We hired Vivek Sharma as Deputy Managing Director. As you know, Vivek superannuated from Panasonic in India, and he is looking after the B2C businesses. We hired head of fan business from another large company. We hired Deepak Mitra for Emerging India, Deepak Himan for TMO. I probably would go on, but just to give you a broad color, we have manned almost all the businesses and functions now, and it's also slightly getting reflected in the employee cost of the company. But we have all the ticks in the checklist in place. Now it's a matter of implementation and execution. And in the quarters to come, we should be able to get better results with the help of these leaders who have joined us very recently over the period of last 10 to 12 months.
Thank you, Mr. Kunal. May we request that you return to the question queue for follow-up questions. The next question is from the line of Gopal Navandar from SBI Life. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, if you can just highlight, because of this decline in the commodity prices in the June, what kind of revenue loss would have been there for cable and wire business, and because of this GTM implementation.
Sorry to interrupt you, Mr. Navandar. Please increase the volume of your device.
Am I audible?
Yes, now you're audible, sir. Thank you.
Yeah, thank you. Yeah, so if you can just highlight the revenue deferment because of decline in the commodity prices for the cable and wire business, and impact on the fan business because of GTM, and whether that GTM is through or it will further have impact on the remaining quarters.
So in our business, Gopal, generally speaking, you would not necessarily witness a demand loss or loss of opportunity. At max, it will be a deferment from one month to another month, one quarter to another quarter, and this is a generalized statement. My expectation is that the second half of the year should be significantly better than the first half of the year, and that is where I would not necessarily would like to quantify the impact on the first quarter, but I would like to give you this comfort that in the history of the company, this was the best quarterly performance as far as the first quarter of the fiscal is concerned. On fan, I think we have completed almost all the alignment. By September, we should be able to complete everything. But fan is a slightly seasonal business, so the benefits of the alignment would get reflected in the next season, which will start sometime November onwards, and more meaningfully in the fourth quarter of this year as well in the first quarter of the next year, we should have some benefit in the P&L because of the realignment of GTM in the fan business.
Sure, sir. And if you can just highlight the gap between the increase in the commodity prices for FMEG portfolio and the kind of price increases we have taken, and are you seeing any kind of price correction post this decline in the commodities in the last 1.5 months?
The way we revise our prices in cable and wire business on monthly rest, same way in FMEG also, we take corrective action as and when required. Of course, after considering the actions taken by other participants at the industry level. We have done that and we will continue to do that. Wherever there is an opportunity to pass on the benefits to the end consumer or increase the prices because of increase in commodity price, we are doing that very promptly, and we will continue to do that in the quarters and periods.
Okay. And lastly, what should be the the long term?
Sorry to interrupt you, Mr. Navandar. May we request that you return to the question queue for follow-up questions. Next question is from the line of Abhijit Akella from Kotak Securities. Please go ahead.
Yeah, good afternoon, and thank you so much for taking my questions. Just a couple. First one was on the gross margins, which have improved quite a bit this quarter to about 25%. Just to check whether there's any one-off item in there that might have boosted these, and should we expect these to come back down in coming quarters? That was one. Second, if you could just give us some sense of your market share trends in both the segments, say over the past year or so, if you have any data points with you. And last one, to clarify, when you mentioned this 87% of revenue coming from the distribution-driven business, does that include some element of institutional sales also within that, or is that only the remaining 13%? Thanks a lot.
Sure, Abhijit. So I think your first question was on the gross margin and EBITDA margin. There is no one-off in the first quarter. As I was mentioning to another participant, we have maintained EBITDA margin of 11 to 13% in cable and wire business, and in the periods to come, we should be able to maintain the same. As far as market share is concerned, in cable and wire business of the organized market, we have almost 24% of market share. In FMEG, we are comparatively small. It ranges between 1 to 1.5%. In terms of pecking order, we would be anywhere between 6th player to 9th or 10th player. So we are competitively that way. In FMEG business, we are small. And on the last one, on the distribution, you are right. 87% of the total revenue comes from distribution. Institutional and export is over and above 87%.
Thank you, Mr. Akella. May we request that you return to the question queue for follow-up questions. The next question is from the line of Ankit Babel from Shubhkam Ventures. Please go ahead.
So sorry, I missed the initial comments. Just wanted to confirm, was there any inventory loss in Q1?
Ankit, you know this business. You have been tracking our company since long. We have a very robust hedging framework in place, and when we procure inventory, it comes with embedded derivatives. And when we decide the selling price of our finished goods, that is when we have the ability to decide the procurement price, and that is why it becomes a pass-through. And that is the reason, generally speaking, I would not expect any inventory loss to incur to the P&L of our company. And to directly answer your question, there is no inventory loss.
Okay, that's it, sir. Thank you so much.
You are welcome.
The next question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Yeah, hi. Thanks a lot, sir. Just one thing in terms of FMEG. If we look at, our
Sorry to
growth
interrupt you, Mr. Mehta. Please use the handset mode.
Hi, Gandhar. If we look at our growth in FMEG segment, has significantly slowed down to our vis-a-vis the market compared to our growth in earlier years. What do you think that is hampering it, and what are we doing to kind of address that situation?
So I would partially agree with you. When you are talking about a slowdown, it's slowed down because of the base effect. When the business is small, the CAGR will be slightly higher. When the business is larger or sizable, the CAGR will go down. So that's to that extent, I would disagree. But at the same time, if your question is on the aspiration, whether it can be better, we are an aggressive company as far as growth is concerned, and we believe that we can always do better than what we have achieved. Only one element which I would like to add here is slight realignment which we have done in the last couple of quarters on the pen business GTM, which has impacted the growth of pen business. But other than that, almost all the large businesses have registered a fair amount of growth. And by 2026, when we are talking about achieving 20,000 crore rupees of top line, FMEG as well as retail wires will have a significant share of that 20,000 crore rupees of top line.
Thank you. Mr. Mehta, may we request that you return to the question queue for follow-up questions. The next question is from the line of Varun Basrur from Julius Baer Wealth Advisors. Please go ahead.
Hello, good afternoon. I hope I'm audible.
Yes, Varun, you are. Please go ahead.
Yeah, so thanks for taking my question. Just wanted to understand, are we seeing any improvement in rural market demand offtake?
It's a mixed bag, Varun. And there are a few pockets where we have noticed there is a slight uptick in demand, but in few pockets, slight sluggishness. But our reading from the ground suggests that this onset of southwest monsoon should help in reviving and improving the rural market demand.
Thank you. Next question is from the line of Deepak from Unifi Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, as we expect a better H2 this year, but we had a healthy base in the previous year supported by, the higher prices. In this deflationary environment, how will we able to defend the strong base of last year in H2?
So Deepak, you know this business. You are an investor in our company since long. As far as B2B business is concerned, we are taking steps to deliver industry-leading growth. And as far as B2C business is concerned, as part of Project Leap, we are targeting to get to a breakout growth. And irrespective of softening of commodity prices, we believe that we would be able to beat the industry growth in cable and wire business over mid to long term. And in FMEG, we should have a significant growth in comparison to industry growth.
Thank you. Mr. Deepak, may we request that you return to the question queue for follow-up questions. The next question is from the line of Srinidhi from HSBC. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question would be on FMEG segment margin, where you have reiterated that your ambition of 12% margin by FY26. Would it be possible to guide us what is going to drive this sharp margin improvement? And price increases are going to drive substantial part of this margin. So that's my first question.
Sure. Do you want to give me your second and then I can take both?
Yeah, and the second one, Gandhu, is that you alluded to some change in the payment methodology during Q1. Can you please elaborate that? These are my two questions. Yeah.
Sure. So, Shalini, first question was on FMEG profitability. One is with larger size, we will get operating leverage, and that is where the EBIT and EBITDA margins should improve. Second is new product development and premiumization of our offerings. As I mentioned a while back, premiums contribution to FMEG top line was around 4% in fiscal 21, almost 8% in fiscal 22, and in the quarter gone by it was almost 12%. And this is expected to go up in the quarters and years to come, and that is where the contribution margin will improve. And third is fair bit of cost optimization wherever possible. So all of these factors should help us in improving our EBITDA margin. Having said that, at the same time, I would expect some increase in expenses. For example, advertisement publicity. In the COVID years, we were following a bit of a soft approach on A&P spend, but I would expect this to go up in the quarters and years to come. That was on the FMEG profitability between now and 2026. Second was on the payment terms. When we procure copper, and we used to procure copper predominantly from the overseas supplier, we used to have the LC arrangement, which roughly means or broadly means that we need not to discharge the liability on day one. We have flexibility to discharge the liability 2 months or 3 months down the line. Because of global supply chain issues, we decided to source some copper from local market in India, and there, since these were domestic suppliers, we opted to make payments on advance basis or on the date of the delivery basis as against availing the LC, and which has impacted the working capital adversely, which is what is visible in reduction number of days in payables. Having said that, in a quarter or two, we should be able to go back to our regular import vendors, and we should be able to avail LCs, and that is where the working capital cycle, as far as payables are concerned, should get normalized. Since we are on working capital, let me also highlight that the channel financing percentage has improved over the period. We are hovering around 75% or thereabout of channel financing, and almost all of it is without any recourse to the company, and that is where the number of days of receivables have improved significantly in last few quarters.
Thank you. The next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Hi, good afternoon, and thanks for the opportunity. Just one question I think is left with me now. On FMEG, Gandhar, we're looking at 60-70% coming from lighting fans. The sector has a lot of large competitors, incumbents. Going forward, FMEG has to play a very large role in achieving, that Project Leap targets. The botheration is essentially coming from how does this, what does Polycab do different in terms of product offerings and getting to that growth number? Because growing this category now at a 1,200 crore base at more than 20% is going to be tough. Market share gains in this category is going to be tough because we have very large competition here. Any thoughts that would help us understand what would Polycab do different in terms of either go to market or in terms of new product launches, or if you're thinking of new categories, because fans and lights are two categories that are highly competitive, and it's very tough to grow at 20% given the category growth itself is like 7-8%. So could you help me understand that? That's my only question. Thank you so much.
It's a great question, Rahul, and believe me, we have invested a lot of time in the boardroom, in the lead meeting and strategy meeting, discussing, deliberating. We have a complete blueprint in place, and the topics which you have touched upon, these are the areas where we are making considerable investment of time and making a lot of effort. Whether it's a GTM, dealer distribution expansion, adding more geographies into our network, whether working on brand architecture and so on and so forth. But let me give you, a broader perspective to FMEG. When we started this business 50 years back, we got into cable, and today we are market leader in cable. Then in 1996 we got into wires. We are a market leader in wires. When we got into FMEG business in 2015, there were many who were believing or who were of the view that we would not be able to get to the type of growth which we've experienced in the last 5 to 7 years. So any business is difficult, any business is complicated, but I think the quality of the management team which we have, we are absolutely comfortable with the top line target of 20,000 crore rupees by fiscal 2026, and whatever steps are required to be taken are being taken, and we should be able to achieve our aspiration of 20,000 crore rupees of top line by fiscal 2026.
Thank you very much. We will take that as a last question. I would now like to hand the conference over to Mr. Gandharv Tongia for closing comments.
Thank you so much for joining us this afternoon. In case if you have any follow-up question, please write to us at investor.relations@polycab.com, and we would be pleased to attend your question. Thank you and have a great day ahead. Bye-bye.
Thank you. Ladies and gentlemen, on behalf of Polycab India Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.